Analyzing income statement of a company.
As an investor, your edge in the market doesn't come from following the hype. It comes from understanding the numbers better than the market. Welcome back, investors. Today we are zeroing in on one of the most powerful tools in fundamental analysis, the income statement. This is where you spot strong fundamentals or flashing red flags long before the market reacts. Everyone looks at revenues and net income, but smart investors, they go deeper into how this revenue is earned, why margins shift, and where expenses creep in suddenly. So if you are skipping the top line items of the income statement and relying just on the EPS numbers, then you are missing the big picture, because buried in the income statement are clues that tells you whether the company is scaling efficiently or if it is burning cash behind a polished press release. So let's get into this, and I will walk you through the key metrics of analyzing the income statement so that you can make better investment decisions. An income statement, also known as a profit and loss statement, shows the company's performance over time. Think of it like a financial scorecard. It basically answers one question only: whether the business makes money or not. At the top of the income statement, we have revenues. This is the money that a business brings in from the sale of its product or service. Below that, we have the cost of goods sold. This is the direct cost which is used to make the product of the company, like raw material cost, fuel and lighting, labor charges. When we subtract this cost of goods sold from the revenue, then we get the gross profit figures. Next up, we have the operating expenses, which is used in running the company, like salaries of employees, rent payments, marketing expenses. Now, after subtracting these operating expenses from the gross profit, we get the operating income figure, which shows profit from the core business of the company. This figure is also known as earnings before interest and taxes. From this, we subtract interest and taxes to get the net profit or the net income figure. This is the final profit that a company earns after deducting all expenses. It is also known as bottom line. So, have you ever looked at an income statement and wondered what the heck is EPS or earnings per share, and why do investors care so much about it? EPS stands for earnings per share. This may sound fancy, but here is the easy version. EPS is the profit that a company makes for each share of a stock that exists. So if a company has 10 crores as profit, and if the company has 5 crore number of shares in the market, then the EPS is rupees 2. Before investing in any company, we have to look out for any red flags in the income statement. If there are a lot of red flags in any company, then obviously we should not invest in such company. First one is shrinking revenue year by year. It shows low demand for its product and service, or the company might also be losing market share. Second one is exploding operating expenses compared to revenues. When the operating expenses of a company are increasing at a faster rate than its revenues, means that the company is unable to control its cost. Third one is inconsistent net profits or consistent losses over time. If the company that you are analyzing is in a cyclical sector like sugar, steel, infrastructure, then the company's profits may fluctuate wildly year after year. Generally, cyclical companies' profits is heavily dependent upon the state of the economy. Other than these red flags, there are some golden signs too in the income statement, looking at which you should invest in a company. First one is consistent revenue growth, which is higher than the competitors' revenue growth. When a company is able to outperform its competitors in revenue growth, then obviously it's a good sign and you should invest in such companies. Second point is gross profit growth larger than revenue, which means that the company has got pricing power and has control over its direct cost like labor charges, raw material costs. Third point is rising net profit margin, which shows that the company has got good control over all its direct and indirect costs. Fourth point is stable tax rate. Tax rate is calculated as tax divided by profit before tax. The company should have a stable tax rate, otherwise it will mean that the company is able to earn most of its profits by manipulating its tax rate, which is a red flag. Lastly, we have to compare the operating cash flow figure given in the cash flow statement with the net income figure given in the profit and loss account. Ideally speaking, the operating cash flow should be larger than the net profit figure. If the operating cash flow is much less than the net profit, then it's a red flag. If the operating cash flow is much less than the net profit figure, then it's a red flag and it means that the company is unable to earn cash from its business. Then we have the interest coverage ratio. It shows whether the earnings of the company is sufficient to cover its interest payments. The formula for calculating interest coverage ratio is operating income divided by interest. Another important item which you should look closely in an income statement is the other income figure. If the other income which is given in the income statement is a very large number and it's more than 30% of the net income figure, that the most of the net income is coming from non-core business activities, which is a non-recurring source of income. So ideally the other income figure should be a very small number compared to its net income figure. तो दोस्तों आज हम एक ऐसे कंसेप्ट के बारे में बात करने वाले हैं जो हर एक इनकम स्टेटमेंट का स्टार्टिंग पॉइंट होता है.
Enter revenue breakdown.
मतलब कंपनी अपना प्रोडक्ट और सर्विस मार्केट में सेल करके कितना पैसा ला रही है और कहां से ला रही है. अब आप लोग मोस्ट प्रोबेबली सोच रहे होंगे कि रिवेन्यू तो एक ही नंबर है, उसकी ब्रेकडाउन की क्या जरूरत है. लेकिन दोस्तों अगर आप बिजनेस को सही तरह से बारीकी से समझना चाहते हो तो ब्रेकडाउन बहुत जरूरी है. चलिए समझते हैं कैसे. सपोज अ कंपनी लाइक रिलायंस इंडस्ट्रीज हैज अ रेवेन्यू ऑफ ₹5 crore. Then from where has this 5 crores come from? That's where revenue breakdown comes in. From the retail division, it earns 2 lakh crore annually. From the oil and gas division, it earns 1.5 lakh crore annually. From Geo, it earns 1 lakh crore in a year. And from financial services, broadcasting and media, life sciences, and from other divisions, it earns the remaining amount revenues. So whenever you look at an income statement of a company, you must search for the revenue breakdown in footnotes to the financial statement to know how much cash each business division is contributing to the total revenues of the company. Now let us discuss a bit about revenue recognition policies. This topic might be a bit technical, but it's super important to understand any business in detail. The revenue recognition policies decide when can a company can officially count its sales as revenue. Many a time a business does not earn money from its sales, but still revenue is recognized in the income statement.
Revenue is a very important word in business. It means the money a business earns. This money comes from selling goods to customers. It also comes from providing services. Think of a shop selling clothes. The money from the clothes is revenue. Think of a hairdresser cutting hair. The money for the haircut is revenue. Revenue shows how well a business is doing. More revenue can mean a business is growing. Revenue recognition is a special accounting rule. This rule tells businesses when they can count their revenue. It is not always when the money arrives. Sometimes a business earns money before it gets paid. Other times it gets paid before it does the work. The rule helps make sure businesses count revenue at the right time. This is very important for accurate financial reports. It ensures that the company's performance is shown fairly. Accurate financial statements depend on good revenue recognition. If revenue is counted too early, profits look too high. If it is counted too late, profits look too low. The accrual method is a common way to recognize revenue. It is a very important accounting concept. Under this method, revenue is recorded when it is earned. This happens regardless of when the cash is actually received. The focus is on the completion of the work or delivery of goods. This means if a service is provided, the revenue is earned then. If a product is sold and delivered, the revenue is earned then. It aims to match revenues with the expenses incurred to generate them. This provides a more accurate picture of profitability. Let us look at how the accrual method works. Imagine a company sells a machine to a customer. The machine is delivered in March. The customer agrees to pay for it in April. Using the accrual method, the company records the revenue in March. This is because the machine was delivered in March. The company earned the revenue in March. The actual cash payment in April does not change when the revenue is recognized. The earning process is considered complete upon delivery. The cash method of accounting is another way to recognize revenue. It is simpler than the accrual method. Under the cash method, revenue is recorded only when cash is received. It does not matter when the goods were sold or services were provided. If the cash has not come into the business, the revenue is not counted. Similarly, expenses are recorded only when cash is paid out. This method directly tracks the flow of cash in and out of the business. It is very straightforward to understand and apply for many small entities. Sometimes businesses have long-term projects. These projects can take many years to complete. For example, think about building a large ship or a bridge. For these situations, the percentage of completion method is often used. This method allows a company to recognize revenue and profit gradually. It happens over the life of the project. The amount of revenue recognized each year is based on the proportion of work completed during that year. Let's look at an example of the percentage of completion method. A construction company has a contract to build an office building. The total contract price is $10 million. The project will take 3 years to complete. In the first year, the company estimates that 30% of the project is finished. Using the percentage of completion method, the company can recognize 30% of the revenue. This means it records $3 million, 30% of $10 million, as revenue for the first year. This is done even if all the cash has not been received. Choosing the right revenue recognition method is very important. The accrual method gives a true picture of business performance. It matches revenues with expenses. This is good for most businesses, especially larger ones. The cash method is simpler. It is good for small businesses where cash flow is key. It is easy to understand and manage. The percentage of completion method is specific. It is for long-term projects. It helps show performance over the many years a project takes.